Well, hello there and welcome everyone to the Advisor's Edge podcast. I'm your host, Rob Jacoman. And guys, listen, I'm really excited. We have a very special episode for you. We have a very special guest that we're very honored to have on our show today. And guys, you're in for a treat because Chad, I don't know, you did it again. You brought in somebody who's a big player in the industry. We're super excited to have Sean Kevelighan on our show. He's the Chief Executive Officer of the Insurance Information Institute. Sean is a player in this industry. He's got a lot of connections, a lot of great relationships, and does some amazing work. So, Chad, with that being said, I'll turn it over to you, and let's join in and welcome Sean to the show.
Yeah, well, welcome, Sean. I think you and I first bumped into each other at NorCal in FPA conference in California.
Yes.
And yeah, we spent a little time afterwards nerding out about insurance, and then we got you on the podcast. So thank you, and I hope life is treating you well.
It is indeed, and I'm really happy to be here with you guys. This is exciting.
Well, it's cool. The presentation that you did at NorCal was great. You know, in California, there's lots of unique challenges, and you really focused on that there. Which was great for the audience. Our audience today is a little bit broader because we're talking to advisors across the nation. So we'll kind of keep it broad. But where I wanted to start with the Information Institute, Insurance Information Institute, I want to make sure that there's a little background for the advisors. What is it you guys do? We know here that you're connecting a lot of dots together and helping move the industry forward. But can you put it in your own words, what that looks like?
Sure. Well, III, as we affectionately call ourselves, has been around for 70 years. And as an organization, we were founded by insurance carriers, really to be a trusted resource to a variety of audiences. So consumers, industry professionals, policymakers, and media. And what we try and do is use data-driven insights to help people understand risk management and insurance. And so we do that in various ways. One of the things we actually don't do as a trade organization is we don't lobby. We get involved in public policy matters, but usually through briefings or public affairs work, but not the direct lobbying. What we do primarily is research on key issues that are happening in and around risk management and insurance. And then we do communications. And so you might imagine we've been really busy in recent years because there's just more and more attention being paid to risk and insurance. And III is proud to be an important source for that and a trusted source. For our media relations, we last year set a record of 22,000 media citations. So we're constantly in what we call rapid response mode, trying to make sure that media and our content are aligning up and understanding things in a positive way.
That's great. Well, thank you for taking a few minutes because you're clearly a very, very busy guy. So joining us here today, and we like to, we're going to get into some of the deeper, I don't know, somebody might say nerdy stuff. We'll try and keep it fun. But we like to also connect individually with who we're talking with. So that's a fascinating work that you do and very, very important. It's kind of the work behind the scenes that needs to get done to be done well. How in the world did you end up at III?
Oh, I mean, I grew up wanting to be in insurance, of course.
Of course.
Doesn't everybody say that?
Yeah, it's kind of funny. I mean, when I was in college doing interviews and I got pretty far in with an insurance company. And I blew the final interview because I just kept on asking them, like, how do you feel about working in insurance? And I probably had a perception like a lot of people do about our industry. But in 2008, I got a call from Zurich Insurance. At the time, I was working in politics with the George W. Bush administration, Bush 43. And that was the last year of that administration. And the job I had jobs in and around economists. I was at the Treasury Department, then I was at the budget office, and they were getting a little jittery around that time, 2000, late 2007, early 2008, mainly about the housing market. And I was getting a little jittery about having a job. coming out of the administration, based on kind of what the speculation was beginning to be about housing and other things. And I got a call from an insurance company and talked to them for a while and talked to them about, they talked to me about their investment strategy and how, most of the industry, in fact, nearly all of it, pure insurance, is going to weather any kind of financial storm they're talking about with these short-term investments that the banking world was in much more than the insurance industry. And it really gave me a peace of mind in terms of job security. And it was going to take me up to New York where I wanted to go next. And that's what I did. I went into insurance. I worked with Zurich for about 3 years, thought maybe I still wanted to go to banking and thought maybe the dust was settling a little bit on the financial crisis. Went into banking for a couple of years and I wanted to go back to insurance. I really enjoyed the people, the issues. There's just so much that this industry is involved in and that we think about in different ways. And I was having a lot of fun creating, whether it was media stories or storylines, just about things that were happening, whether it was climate risk or aging workforce. This industry thinks about it all. And so the other thing, though, that happened to me is, that was right around the time when we needed to actually tell an important story about the industry. We, the industry, needed to tell the greater audiences that we were going to be just fine getting through that financial crisis. And we are different than the banking world. And I presented that to the organization I'm now with, III, and I kind of got shot down by peers in doing it. And I stayed with Zurich and I was at, in Zurich. I actually was in Zurich, Switzerland, heading up their public affairs and corporate responsibility, and great job, great place to live. And got this call about III. I remember that I felt as though we could have communicated better after the financial crisis. And I thought this organization was the right organization to start, moving the needle in different ways about how people understand insurance. And so here I am talking to you guys.
That's great. Yeah, the interesting thing is the intersection, and obviously in Zurich, in the town and the company, there's an intersection of all of it. Yeah. And one thing that comes up for us since we met at a financial advisory conference, and where that intersection comes together starts to get really fascinating with us. And I'd like to dig into a little bit when we're looking at industry challenges and trends. What are some of those trends from the insurance perspective where we might get a little bit of overlap in financial services?
Yeah, I think, from our standpoint at III, how we look at issues is we look at the industry and what is the opportunity or risk to an issue versus what we do at III and how much we think we can put emphasis and inform those issues. I think primarily, when and if, we kind of intersect in financial services, I like to say that we try and help people understand that insurance has a very good story to tell in comparison to the broader financial services world. We just talked about earlier, why we can weather economic, whether it's recessions, we tend to be, virtually a recession-proof type of industry, or even the likes of a global pandemic where we continued to hire and even, secure jobs and things. And so that's because we look at risk in a long term and we invest for the long term. And I think that's one of those things that probably most people don't quite appreciate or understand. And we actually, most of the time, we're contributing more to the economic growth, the GDP than banking, and we're usually twice as big as securities in terms of our contribution to economic growth. So there's a good story to tell about how insurance drives economic growth, and it's different in terms of financial services, and that is something we spend some time trying to help people appreciate and understand.
Yeah, so what I'm doing there, Rob, when you're ready to jump in and ask a question, feel free.
I have lots of questions.
Well, jump in. What's the burning question for you there?
Well, I mean, I could take this in a whole different direction, but I just want to make sure that I also, Chad, I'm following your questioning because I'm looking at your briefing and I'm following your flow, and I'm happy.
Okay.
I'm happy to jump in anytime. Trust me.
Okay, cool. And what we got, Sean, is we'll do adjustments as we go. I just want to make sure that we keep us all in the loop. Yeah.
I'm hearing a lot of background noise and I don't know why. I'm just making sure. I'm doing a quick sound check here.
Yeah.
Can you still hear me?
Yep.
I can. Yep.
Okay.
I had a fan going and I turned it down.
Oh, well, maybe. Can you guys hear me okay?
You sound great. Yeah.
Wow, it all of a sudden disappeared.
Well, good.
That sound. All right. Chad, where do you want to pick up? Where do we want to pick up where we left off? So here's where Sean was. He was talking about, you asked me a question about the financial industry and insurance. What I'm curious at understanding is, where does the financial services, because why should a financial advisor care that Sean's on the show right now?
Yeah, I like that question. Why don't we just jump in right there?
Okay, hold on. 3, 2, 1. All right, so Sean, I have a question for you. Obviously, you guys met at NorCal, and you're obviously, we can see where the insurance industry and the financial services world kind of intersect. I mean, you know that, I know that, but let me just cut right to the chase and ask you a question. Why should any financial advisor, or let's say I'm running an RIA firm right now, why should I be concerned about understanding insurance, understanding the insurance marketplace, industry trends, what's going on in the insurance world? How does it impact me as a financial advisor?
It's a really good question. I think the short answer is if your clients don't have enough insurance, that could mean that they don't have enough in there to invest in as well, correct? Or that could take a hit on their investments. The other part of that would be having life insurance. We don't focus entirely on the life insurance side of the business. About 70% of our members still offer life insurance, and that is a very important part of managing personal risk as well. But what is happening in particular right now is many clients are experiencing increases in insurance costs. And they probably don't fully understand what's all behind them. And they're probably hearing different things that are out there that might be behind them. And they may not fully appreciate kind of what's behind this and how they need to plan for it, because they're not just, have a hunch that it's increasing. Over the last 5 years, insurance prices have been increasing. We've been in what we call a hard market. And, mostly in the last 4 years, that's been driven by significant inflation. So why does inflation matter to your clients and any insurance customer? Well, when you have a claim, you've got to replace things. And if things are more expensive, then it's going to be more expensive to replace it. And so through COVID, when everything locked up, that locked up all of the supply chain. And that just took a significant hit not a hit, I guess, it just bolstered prices significantly. So the 5-year replacement cost increases for homeowners, lumber materials, those types of things, 30% increase over the last 5 years. Personal auto, parts, automobiles, 28% over 5 years in terms of replacement costs. And then commercial property, about a 20% increase. So we're hearing now about inflation costs and where it's going, and we're seeing inflation getting more in check, but you're not going to see it go down 20, 30, 35% like we saw in the last 5 years. And so that set a new norm on pricing and insurance pricing, because the price of insurance is a reflection of the risk. It's not the cause. And some of the cause of a rising risk is that things have just gotten a whole lot more expensive in this country as it relates to insurance replacement costs. So that's one big thing we have been talking about really nonstop for the last 3-4 years, helping people understand, because yes, there is also increasing natural catastrophe loss costs as well related to climate. Those have increased, since the 80s, about 10 times in terms of insurance losses related to natural catastrophes. So you are seeing a significant increase in catastrophe costs, increasing costs in the cost of capital. We are in the midst of a legal system abuse crisis in this country where people are going to litigation first and not as a last resort. And then you've now also entered into the picture as the inflation and the costs are going down, just general inflation, we're adding in the geopolitical risk inflation, the tariffs type. And that's a lot of uncertainty as well in terms of how we're pricing things. We haven't seen the prices kick in like we think they will based on some of the rhetoric that's out there, but the rhetoric is changing literally by the day, if not the minute. And so, but at the end of the day, tariffs will have an impact on prices as well. So it's important, I think, for financial advisors to be armed and understanding of kind of what's behind that as they're advising their clients, because you don't want to be underinsured either. You want to make sure that if something happens to your client, they've got enough insurance to cover them. You know, and it's not just the property part of it; it's the excess liability as well that many financial advisors should be making sure their clients have. So I think we do serve an important role for financial advisors because risk management is absolutely important as you're managing your finances.
100%.
Yeah. I love how you kind of focus it in on for our advisory clients that we're working with, what's important to their clients. So they give I think that was a pretty clear explanation of over the long term. And it's a good reminder that insurance is absolutely over the long term. It's not about today, this month, even this year. It's you said over the last 5 years, what does that look like? Right. Which is an interesting perspective in and of itself. Which is fantastic. Tell me a little bit more. You kind of alluded to something interesting there when you're talking about legal system abuse, because, for the insurance we help our advisory clients with, it's all about legal defense if somebody gets upset. And so what do you mean when you say legal system abuse? What's happening there?
Yeah, the general problem in this day and age is that the policyholder and the plaintiff attorney practices are really increasing costs. And why they're increasing costs is they're encouraging, the claims to go to litigation first when it had been and usually advised to be, or historically had been advised to be a last resort. Now you've got, an explosive and exploitive billboard attorney problem. Right? Where you just see them everywhere, TV, billboards, social media. They're also, the attorneys are increasing their fees. We're seeing an erosion of our caps on the damages happen. They're introducing legislation to get rid of caps get rid of insurance caps. And then you've got a global multi-billion-dollar asset class going on right now of what's called third-party litigation financing, where literally the likes of hedge funds and sovereign funds, private equity are investing in cases that they think could go into, what's referred to as a nuclear verdict, $10 million or more. They've got all these algorithms trying to figure it out. And what's that happening is all of that is creating costs to go up, but it's also usually creating a situation where the claimant is getting less as well. And when we're finding it through our research at III and as well as the Insurance Research Council, which I oversee as well, that it's beginning to set in that people are not just finding this stuff annoying. It's beginning to set in that they're seeing that this is part of the problem as well. And we're doing work to help people understand that it's absolutely part of the problem. There are claims in lines of business like personal auto, increased in a 10-year period through our research with the Casualty Actuarial Society. We saw on the commercial auto, it went up about $50 billion over 10 years, claims prices. And on the personal auto side, claims went up between $75 and $80 billion. That's real money. That's not just general inflation. And so we're trying at III to help people make the connection that this isn't just annoying. It's costing you and it's costing everybody else. And we need to start doing something about it. And so we have seen some states take it on. When some of these states are feeling as much pain as what Florida was feeling 3 years ago, when you had close to a dozen insurers had gone insolvent and there hadn't been a major hurricane in a few years. but they just couldn't pay the legal costs. You had, at that time, about 3 years ago, you had over 70% of all litigation, homeowners related litigation in this country resided in the state of Florida.
Wow.
But the state only had around 10% of the country's claims. So they had something in Florida called assignment of benefits, which we call legalized fraud, because it basically was a system designed to inflate claims 10, 20 times what they should be. Florida took it on, Ian hit, and everybody was asking whether or not the insurance market there in Florida was going to survive. And I think the politicians paid attention to that. The governor stepped in and said, we need to get some reform in this place. We got to get rid of this stuff. They did. And now 2 years later, after it's been passed, we're actually seeing insurers submit decreases in rates in that state. And we've seen 11 insurers come back to the state since all this passed. So legal reform can make a difference, but it's been making a negative difference for a very long time.
Yeah, that's interesting. One of the things I was thinking of as you were going through that, it made me want to ask a really contentious question, which could be a little bit of a funny way. But I think about how there's kind of a checks and balances between the legal side and the insurance side. And of course, the really good insurance carriers, they got a really good handle on what's going on the legal side of it. And what you've done is you've kind of walked through both sides of that coin all in one conversation. Was there anything I missed there as far as, because you talked about it went too far in Florida is what I heard. And then it's getting pulled back, which is bringing good, strong carriers back to Florida, generally speaking. Is that right, or what I miss?
That is right. And I think people understood that pretty quickly. And then what happened the year after Florida passed the reform is you saw literally like ants crawling over, the state border. All these cases all of a sudden began surfacing in the state of Georgia, which has traditionally been known as a plaintiff-friendly environment. And lo and behold, they started seeing some aggravation in terms of the potential availability of insurance. The rates were beginning to go up, and the governor of that state had to do the same thing and began to take it on. And they, in fact, this year passed legal reform as well. We tried to get in there at III to help people make this connection. And what we found too is the words really matter about how you talk about this stuff, because our industry for decades has called this problem social inflation, which our research and others' research that we collaborate with shows that nobody knows what the heck that means. And it's not making a connection. So we have, and you've been hearing me say the term legal system abuse, because people are beginning to make that connection. And so much so we found out is we actually did a test in 2024 where we put a billboard up in Atlanta, and it said simply legal system abuse increases your insurance costs. We put a microsite together, stoplegalsystemabuse.org, where someone could go on and on that microsite understand the economic impact in Georgia. Then we put some digital advertising around there. Our digital advertising on bus stops actually said billboard attorneys increase your insurance costs. The billboard company wouldn't allow us to put that on the actual billboard. And we did social media, and the way for us to measure whether it was effective is, how many people were actually clicking on this stuff. And at the time in our test campaign we ran for 3 months at the end of 2024, the click-throughs were about 5%, which actually we were really happy with, because usually click-through rates are at 1 or 2%. Well, we did this again during the legislative session in Atlanta, and we also did it next in Baton Rouge, Louisiana, and we did a digital campaign in Florida all around the legislative sessions, because Florida already, they're trying to retract the reform, even though they're seeing new insurers there and rates going down. So when we did these campaigns during the legislative sessions, our click-through rates, Georgia was about 14.5%.
Wow.
Florida was 15.5%. Louisiana was around 10%. So what that tells us is people, if you use the right words and you use the right tools and illustrations of the problem, they're getting more engaged. And they're beginning to see the problem. And we're even through the Insurance Research Council finding that people are beginning to say, yeah, this is, I see it. Mostly our research 3-4 years ago said most people see it and they didn't make the connection. Now they're beginning to see it and say, yeah, we're probably paying for that stuff more than we think. So
Right.
that's where we're trying to go with it.
So you can't put a billboard up that says slime ball ambulance chasing attorneys? I'm just kidding. I could take that out.
I wouldn't say that. We don't like to say those types of things at AAA, but I will say that, billboards they're like a V, right? You got two, one for one side of traffic and the other for another. The one on the back of ours was, in fact, a personal injury attorney. So
interesting. Yeah.
They're a big funder of the billboard community, so I can imagine that they would want to protect them in some shape or form.
Well, they also have a strong lobby. I mean, when you have a bunch of attorneys who are in public office, who are also pushing this narrative and have self-interest and personal interest, those interests get in the way of the public interest in terms of what it does to markets and economies. So don't even get me started on down this path, because it happens on the commercial side.
Absolutely. Commercial auto has been a line of business that has just been plagued by legal system abuse for years. I mean, that aside from when it was 2020, we didn't see a combined ratio below 100 in that line of business for over 10 years. In 2020, it wasn't just the roads closed, the courts were closed too, right? Mm-hmm. So that business is a general liability, same thing. I mean, it has been, the commercial space absolutely falls victim to this stuff. And so I'd say it's probably the most talked about issue that I come by when I'm talking to an insurance professional on the carrier side, on the broker side, and on the service side. Everybody's understanding that this is the biggest problem we have.
And interesting. I will say this, that I think we need to do a better job. As the industry as a whole needs to do a better job educating not only the public about truly what is insurance. Because a lot of people just look at it as a commodity. They check the box. They're like, well, it's a necessary evil, but they don't truly understand what it does to help benefit them and protect them and their lives and their businesses. So I think we need to do a better job as an industry as a whole, educating direct to consumer, especially on the commercial side, because I can see that gap right now, because people have this perception of the big bad wolf. The big bad wolf is the insurance carriers. They're making all this money. They're after us. And what I think it does is it really impacts the perception of a broker or an agent who's just trying to help people.
Yeah.
And it drives me nuts, because this is one of the personal things that I'm on is like, we also need to do a better job as a profession educating other trusted advisors that people have to have in their fortress of relationships, like their financial advisor. Financial advisors, they're not experts in insurance, but we have an obligation to help them better articulate the value and the benefit of having the proper coverages in place to protect not only people's lives, but also those that have businesses. Because there's a lot of financial advisors, obviously they work with a lot of business owners, a lot of CXO level people who are running big companies. So I think to overcome the perception problem of the industry, I think that's where the educational piece really fits in. And we just need to do a better job educating people, as well as all of our trusted partners around us, the value and the benefit and what insurance really is meant to do.
Yeah. And I think we take that very much to heart at AAA. In terms of how we approach discussions and making sure, that the team, one of the things we always say as a team, we have to lead with empathy as well when we're talking about this stuff, because it can be frustrating. But if you think about it from a financial advisor standpoint, and you can go to get our information to show them, on average, a claimant gets less when they get an attorney involved. So as you're advising and your clients may be saying, I'm going to, sue this guy, because of my insurance claim, the facts say that they might not get what they think they're going to get. And so it is important for people to understand, the reality that these billion-dollar numbers that they're putting on these cases, that creates a large pie, and there are a lot more players that are trying to take bigger pieces of that pie. And that can drain somebody's finances if they go at it in the wrong way as well.
Hey, Chad, can I ask can I, if you don't mind, I don't mean to, it's actually has to do with this. I cut this part out. Do you guys mind if I share a quick story and how this relates to exactly what you're talking about, Sean?
Sure.
Yeah.
So I have a client who's in the home building industry. And one of the things that they do, they're a broker and they work with home builders. And one of the things that has come up recently is making sure that home builders are properly protected from potential lawsuits and litigation from new home builds from homeowners. And it's so interesting to me that the way to solve that problem, and sometimes the simplest solution is sitting right in front of you, but people just don't understand. Like, it's literally that simple. So we've got a big education campaign going right now where we're talking to home builders, or they are talking to home builders, but I'm putting all the stuff together for them, that why it's so important to have all of your contracts in alignment so they're all kind of speaking the same language. And what I mean by that is when you have the right risk management, proactive risk management best practices in place with contracts, with your GL policy, with your subcontractor agreements, with your sales contracts with the homeowners, all these different things need to be in alignment because you want to keep yourself out of the legal system. So the last thing you want is you don't want a homeowner suing you and then you end up in a court when in fact the contract that you both signed actually said, no, we're not going to let you go to court on this. We're actually going to take you to arbitration, which is a much more cost-effective remedy to solve these kinds of disputes. And I think that kind of ties into what you're talking about. There's a lot of risk management best practices that a lot of business owners can take more control of to prevent themselves from seeing themselves in a courtroom and getting sued. It's just that's what escalates a lot of the costs. That's what I understand you're saying.
Yeah, and I think what you're talking about, in my opinion, is something where the industry is also shifting itself. You're talking, in my mind, is about managing and mitigation and making your clients more resilient, right? And that's in many ways how the insurance industry is shifting as well, from just being something that detects and repairs after catastrophe to actually helping customers understand how to predict and prevent it. And I think that's exactly what sounds like you're also doing as an advisor is you got to know that this could be coming and you got to make sure you do what you can to prevent it from coming as well. And I think that's a key element that's coming more and more into the risk management process.
Well, the cool thing is in the risk management process, just like you're talking about with your insurance brokers working with home builders, coordinating those contracts, the same sort of thing happens in financial services. For example, if we're talking with a TAMP and then they have RIAs that are working with them, there's contracts that flow all the way down to the end user that is not necessarily an expert in this area. And we don't want that end user, the homeowner, to get upset because they misunderstood something that flows in the legal path back up. So I think the coolest thing that's happening with technology, being able to see these linkages more easily, and we're just on the cusp of being able to see that. So we're going to continue to build on that. I want to take a quarter twist here and think about interesting thing in the financial services. We also, because our financial advisory clients are looking to grow assets for their clients. And I've run into every once in a while, maybe it's a private investment company or either it's coming up in different areas for these funds that are investing in litigation. And that's kind of a third side of that coin of how it looks. And we certainly don't want to expand the legal expenses that take all of our insurance rates up, right? We want to do everything we can to limit that. Can you tell me a little bit about how does that look from III's perspective on what's going on in the investment side of it?
Well, I mentioned before it's become third-party litigation financing has become a global multi-billion-dollar asset class. When something becomes an asset class, it's almost never going to go away. It is big business. It is an illustration of the big business of U.S. law, because the expense here is more expensive than other. We've done studies that show that the expenses around the likes of liability and litigation are much more expensive in the U.S. than other OECD countries. But the other part of this is it's all dark money for the most part. We can only find one publicly traded, admitted third-party litigation financer. And if you go to it's Burford Capital, and if you go to their earnings reports, you'll see some pretty good results because they're global. And so they're taking sovereign sometimes sovereign investments. They're taking foreign investments, and they're making a lot of good money on this. And again, they're another insert into that, taking a piece of that pie. Again, on average, a claimant will get about 12 to 13% less in a case if a third-party litigation financer is part of that. That is something that people need to appreciate and understand. It's also a tax issue. If they're sovereign funds, they're not paying taxes, and it's a national security issue. There have been examples where we even saw when there were Russian sanctions were being applied that the oligarchs were putting their money into third-party litigation financiers. So if somebody wants to do harm to the United States, why not try and do it through setting off and blowing up the legal system? So this is a problem that is really has tremendous results in terms of its impact, but it has really zero transparency. There was a few cases in Delaware where a judge asked the plaintiff side to disclose if they had third-party litigation financiers, and they just withdrew the case. There was one example where where a third-party financer actually wouldn't allow the claimant to settle because they believed they could get more out of it. So there's a lot going on. There's not a lot of disclosure in it. And only just a few states are beginning to do it. They tried to actually tax it at a federal level in the big, beautiful bill, and that got withdrawn out of the bill before it passed. So, and it got withdrawn because you saw money coming through the likes of Burford Capital on people's campaigns, right? And you actually saw in that particular case, because they're publicly traded, their stock started going down when there was the potential for that tax to go through. And as soon as it didn't go through, it went right back up. So there's a big business of U.S. law problem that's going on, and it's third-party litigation financing, it's mega billboard attorneys, it's people treating this like a lottery system in ways.
Well,
Sean,
I'm going to step out.
Can I ask a question about this? A follow-up? Anyone in chat, I think you know this too, because anybody who's ever been involved on the claim side and who's been part of working with claims adjusters on some big stuff. Like I was a work comp guy and risk management guy. So, I had the opportunity to be part of some really big claims and get involved on all those sides. Sean, how does that litigation risk or litigation financing model, how is that impact when it gets into the insurance side where people are trying to settle claims, maybe messy claims, maybe some big claims? I know that I've been in situations where they're like, listen, let's just settle it right here. We'll take a smaller number. And then how is that impacted actually going to judgment or actually going into a courtroom with some of these really bigger claims on the commercial side?
Well, they're simply just using tactics to make sure that claim gets inflated, right? Mm-hmm. Or that they can go to the bad faith part of it. There are a lot of different tactics that they're taking. There's a reason why auto claims, both commercial and now personal is picking up. There's a big reason why the liability losses there's a wide margin between these. In personal, they used to be pretty aligned, physical damage and liability damage, because personal auto claims aren't that big, but now they're getting big. And you're seeing that margin between physical damage and liability damage get bigger. Commercial, it's always been a big difference between physical and liability. So they figured out, and unlike we're trying to do better in this industry, but the plaintiff side has been collaborating and working together on this stuff for a very long time. And they've figured out formulas and algorithms to identify the right cases, to identify the multi-district litigation or multi-jurisdiction litigation, ways to inflate these cases. And when they see one hit, they all run to it. So it's a lot of different tactics that, quite honestly, are a bit ahead of us, and we're catching up as an industry.
Well, I think the education that we're doing today is going to be very helpful. And I'm going to go out on a limb here and say to the financial advisors that are looking at third-party litigation, investing into it, be very cautious. Be aware of what you're doing. How does that affect the big picture? Because what we really don't want to do is we don't want to do things that actually encourage bad litigation. And I say, maybe this is unfair, but bad litigation is litigation that's there just to inflate the costs. I don't really think that helps any of us out in the long run. In the short run, certainly there'd be some winners, but it's not worth it, in my opinion. And that's where I go out on the limb. I don't know how that sits with you.
Yeah, well, they're sneaky too. As a financial advisor, make sure you're looking into all of these investments, because I've heard more than one anecdote where people find third-party litigation financing in an investment portfolio and it didn't look like it. So you got to make sure you know what you're helping your customer, your client advise in or invest in.
Yeah. Well,
so interesting.
Knowing what you're investing is important.
That's a whole world I just learned about, Sean. So I really appreciate. There's always a reason why we have guests come on that sharing your wisdom and sharing something like that, I think is so valuable to. I think it's so valuable to the education. Just putting it out there and letting people do their own homework and their own research. I mean, my goodness, I didn't know any of that kind of stuff was really going on until you just shared it now. And I feel like I'm pretty plugged into the industry and have a really good pulse of what's going on. But knowing that is so valuable. And I appreciate you bringing that to the forefront.
Well, if you or your listeners are interested, we do what we call e-blasts every week or so. And there's we have a backlog of things that we can talk about on this issue. But we put something out, whether it's legislation that might be out there or a huge settlement where the attorney will say just how much of I think it was the Surfside condo devastation that happened in Florida when the apartment building collapsed. And the attorney, came out and said he was giving them a discount of multi-millions of dollars, right? And so we take these stories because they just tell themselves, and we just feed people just a little bit of an understanding of what all this means. And there's a lot that we put out around third-party litigation financing. There's a lot we're building on, the big business of U.S. law. There's loopholes now in states like Arizona that are allowing, which used to be illegal, where third parties can invest in law firms. And so there was a story, I think it was in the Journal, where it was KPMG was investing in a law firm in Arizona. You're seeing this happen with hedge funds and things. So it really is becoming this huge, big business where a lot of us are paying the price.
Yeah. Conflict of interest for sure.
Yeah. What I'm curious on the niche side, because we're kind of a niche focus with financial advisors, right? And then you might see a bunch of niches out there, and maybe some of them are bubbling up on the insurance side. What are you seeing out there? Or maybe, I'm thinking maybe AI space, maybe in the cyber space, maybe there's something out there we just don't know about that you can help teach us.
Yeah, you can imagine there's a lot, and some of what we've talked about already here about inflation being something that it is. We just haven't seen inflation like this in decades. So it has become kind of a niche issue that's on our radar again. Certainly the legal system abuse. The AI is interesting. We did some research first around just ethical AI. Just making sure, as insurers, and we're using AI to do things like underwrite, that just knowing how the AI is being used, how we're communicating internally and externally and with regulators. I mean, the property casualty insurance industry could potentially one of the most regulated industries probably in the world, with 56 different regulatory jurisdictions in this country. So as we're using AI, what and how we're using it will be important in communicating that. Also, though, a niche around AI is AI insurance. There's potentially I don't want to say it's a problem. Perhaps it's an opportunity, but you could argue right now that there could be some silent AI in claims because of whatever types of things that are out there. Much like what we saw with cyber, these claims could be AI related, but it's not carved out specifically in policies. We know one carrier at least that's offering AI insurance for that reason. So covering the specific risks of dealing with AI. And so that's a big niche issue for us. Also, how we're pricing insurance, that is constantly something that we have to make sure maintains the continuity that it needs. Because oftentimes we'll see that people don't understand and want to make political hay out of using credit scoring for insurance underwriting purposes. I mean, I think a financial advisor also appreciates that is a very good measure of financial responsibility on a credit score. And if you're financially responsible, you're going to manage your risks more responsibly as well. So making sure that and then the geopolitical risk right now too, with the tariffs, with just the geopolitical risks that are out there between countries that could potentially lock up certain parts of our supply chains, which, as I mentioned, when we were talking about COVID and the supply chains locking up, if you lock up some of these supply chains, that's going to put more pressure on pricing and goods, and that all has an impact on insurance costs.
Yeah. Wow. Lots of big important things you're touching on there. I love that you're telling us about you're getting that information out to firms like us and other advisory firms. What other kind of support, educational, or mentorship aspects? We're going to make sure and get it in the show notes there. Yep. But what other aspects of information channels might be helpful for our clients and listeners to know about?
When you say what other information channels, so we certainly, you're going to get to iii.org. We get anywhere from 3 to 5 million visitors every year coming to our website. We try and be objective in what we provide. For insurance, I really don't think there's a better source, and I'm not saying that because we're part of it. I think just we're historically, in terms of our share of voice in the insurance industry, we represent about 60% of any and all media or web traffic that's going to it. We're very trusted as well. We actually use a system that tracks our trust levels, and we are at the top in terms of how we present things. So we're a resource. We've had some financial advisors become individual members of III.
Interesting.
Because they can they sign up for what an independent insurance agent. We have a product called Independent Agent Pro, and it allows them to sign up and get our economic reports we put out. We update economic and financial performance through actuaries and our economists every quarter. So that's just a good way where you can actually see where things are trending in terms of prices of insurance and how things are performing well and what's behind it. But also other materials, issue briefs that we put out on various topics. We've just been focusing. We focus this year a lot on the states around legal system abuse, but we are just putting one out right now, putting one together too on wildfires, different things, just different parts of the industry and what's going on. The excess and surplus market insurance.
Yes.
That's becoming a big line for the industry, and explaining why that is and things. So. That is something, it's a relatively small cost. I think it's a couple $100, and we're finding some of the financial advisors are asking if they can qualify to come in and get it. And we put out a great daily newsletter that just talks about 3 big stories and then gives you research behind it all. So there's a lot there. I am actually thinking of other sources, but I guess I'm so ingrained in what we're doing. I tend to truly use our resources, and then other media outlets is what I get every day.
Well, I appreciate you sharing what your resources are, because I think even though I am in the insurance industry every day, it's easy to forget about the quality, trusted services that III brings to the table. And I think it's helpful for our financial advisors to know about it, because when you're looking at broad economic trends, you guys are doing some research that helps pull that in. And they might find a wealth of knowledge there that they didn't expect would be useful for them. We know there's a wealth of knowledge there. I think it probably is going to be more useful for financial advisors than they would probably think at first glance.
Well, it is. It's risk management is a part of financial advisoring. I don't know if that's a word, right, advisoring, but I tend to do that, make up words. But yes, it's an important part of it, helping your clients, like I said, predict and prevent, so that those assets and investments are staying in place in a good way.
Absolutely. Well, fantastic. Are you getting ready to land the plane there yet, Rob? Or you may have a burning question I don't want to miss.
No, I'm actually I'm gonna help land the plane right now, because I'm gonna ask I'm gonna ask Sean the legacy question, if you don't mind.
Sure.
Yeah.
So Sean, we always love to finish our episodes with really going deep into purpose and meaning and mission. And I want you to sit back for a minute here and just kind of reflect on imagine you're in retirement right now. And I don't see a guy like you retiring, by the way. I see like you're like an Energizer bunny. You got so much energy and passion. It's amazing. But I want you to imagine you're retired now and you're just looking back on your life and your career. I want you to think about how do you want to be remembered, and what do you want your legacy to be?
So it's in many ways why I wanted to work and have this job. The insurance industry has given me and my family a great career, a stable career. And I've got to get ingrained in a community that's a really good community. And I've gotten to get into issues that I would have never thought I'd be into, like we've just been talking about today. And so I'm constantly learning. I literally learn something every single day about this industry that's unique. It just has so many different elements to it. But go back to what we talked about when I first started and told you how I bombed the job interview. I, like many others, think working in insurance is like Ned from Groundhog Day, who's running around chasing you to sell you a policy of some sort until you have to knock him out. And I'm not saying anybody should knock anyone else out. That just happened in the movie. But I would say, if I could look back and I could say that, insurance is looked at differently. It's a sought after career. It has really good careers in insurance that, people are happy in and well compensated. So we see an actual trend where people wanting jobs, and actually see people actually seeing that insurance does provide a lot of good. I think that may be an insurmountable goal, and maybe that's why I won't ever retire, but it is one that I would like to see. And I do feel, just in this campaign that we put together in these states and the engagement of it, I do feel like we're beginning to move the needle on how people perceive the industry versus some of the other stuff that's going on. And for me, right, a big thing of that in our team, and we have an amazing team. We've got 7 spokespeople right now with, I would imagine a combined 300 years of insurance experience and I'm not joking. Like there's a lot of people that were senior in their careers that come and work for us because they like what we do. And so just, those people getting that word out more and moving that needle more is something that, I hope, people see that we transformed an impression of the insurance industry.
Man, you said it all right there. It's like perfect. I share such a similar passion as you, Sean. And we won't go down that road, maybe because we'll have you on another time, but I feel a similar level of passion for elevating the industry and really helping, fuel this industry with some really hungry young talent and giving them the mentorship and the training and the guidance that they need to help develop them into insurance professionals. I think it's a wonderful opportunity, and nothing would bring me more joy than to say that I played a small role in helping to transform the industry in a positive way. So I love what you said there, and I will put all of your links to reach out to Sean and be part of his organization. We just absolutely loved having you on today and learned so much, and it was so valuable. So Sean, thank you so much from the bottom of our hearts, and to all of our listeners and audience. It was just such an honor and pleasure to have you on today.
Oh, it was my pleasure. This was great, guys. I really thank you for having me. Thank you for those nice things that you said in the beginning. I wasn't sure I'll ever be able to live up to those nice things that you said about me, but it's been great to be here with you.
Well, we appreciate you, Sean, and III, all the work you're doing. It's really important. Thank you.
Thank you.
Love it. All right, guys, we'll see you again on another episode of the Advisor's Edge podcast, and we'll see everybody soon. Take care, everyone.